Thanks for joining us today on Market Call. I'm Morella Fernandez. Jamie Murray on the show with us today, president of Murray Wealth Group. He'll take your questions on North American equities, and here's how to reach us. 1-855-326-6266. If you'd like to dial in, you can email your questions in as well, marketcall@bnnbloomberg.ca. Thanks for coming in. Good to see you.
Nice to see you too.
So many different things playing into the markets these days. A lot of the uncertainty returned with geopolitics now. But what's your outlook for North American markets this year?
Yeah, we're still pretty constructive on the markets. I mean, we've been long the tech sector for the last 5-10 years even, and we still think that has a great outlook. We think we're going to see AI continue to flow into the enterprise market. So it's really just been consumer chat GPT, rewriting your wedding speech and stuff like that. But now we're going to see the agentic commerce start to come through. We're going to see enterprises bringing that in. So that's an area that we like, and that's obviously a huge part of the S&P 500 in the United States. So we think that's going to do well. And we're also seeing a rebound in, I'd say, sort of the real economy companies. Auto production, auto stocks are doing better. When you think about the equipment rental companies, like a company we own called Herc Holdings, it's up about 30-40% in the last 6 months. So we're seeing a turnaround in the real economy, and we think that's going to continue to push the market higher. Why
do you think that is? Because we did see at the sort of fall turnaround point last year, people taking money out of tech and redeploying it elsewhere. Do you think that is what we're continuing to see now?
Certainly, I think like the tech's had a great run over the last 3 years, and we're now in sort of a digestion phase where we've seen multiples expand. Now we're kind of seeing them level out, and we're going to need to see further earnings growth and further revisions in EPS for a lot of these companies moving forward. But then just on the real economy too, like we're seeing, I mean, interest rates are lower. That's helping out. We also in 2021, 2022, ahead of the inflation spike, there was a huge surge from the stimulus by different governments around the world. And so I think we did get a little bit too far ahead of ourselves on inventories in a lot of areas. And so we've had to work through that. That's almost been a 2 or 3 year cycle. And so we're just seeing that start to turn around and some improvement there.
Okay. Considering what's been going on over the past few days, I'm wondering whether commodities are of interest to you at all at this time, or if there are other sectors that you're not interested in or not looking to this year.
Yeah, certainly we have some exposure to the metals and materials sector. So, obviously it's been a great performer last year, seeing that strength continue, and that still has a good outlook. But the one sector, I mean, we're still shying away from and not really taking a dive into yet is the consumer staples. There's a broad number of companies in consumer staples, whether it's personal care, the alcohol sector. We just see a lot of headwinds across the board for these that are more structural in nature. And so you've seen the multiples of this sector come down like a ton. Used to trade, I call it 20 to 25 times PE. Now some at 10 to 15. But we just think these structural headwinds are still going to continue. And whether that be pricing powers, non-existent right now, the low-end consumers moving to private label. It just seems like there's even digital economy that takes away a lot of the physical shelf space that these companies used to have, where there's now more options. So we just see a lot of headwinds for the consumers staples group this year.
Got it. All right. We are going to take a quick break. Jamie Murray, Murray Wealth Group, taking your questions today on North American equities. Here is the number and the email if you would like to put your questions in. We're back in just a moment. Stay tuned. Welcome back to Market Call. Jamie Murray with us today. We're going to start with an email today from Brad. He says, I purchased POW in my daughter's TFSA in January, so Power Core 2021, and I've seen a 29% annual rate of return. It has become the anchor for her portfolio. Should I be selling a portion of this to balance, assuming it'll continue to rise, or just sell the entire position? So what's the rule of thumb when certain stocks begin to take over your portfolio? Is there a percentage you keep in mind to bring it back to?
Yeah, definitely. I think upwards of 20%, I'm generally comfortable in a long-term portfolio like a TFSA, especially with like a core holding like a Power Corp. So we own Power Corporation. We also own Investors Group separately from Power, which Power owns a large chunk of IGM Financial. So we like the stock. It's had as you said, it's had a great run over the last 3-4 years. The multiples expanded from like a 9 PE up to a 12 PE. So they're doing all the things that you want to see, but the stock is getting a little bit more expensive. It's not as cheap as it was. We have been trimming it. So I think this is one where you maybe do want to trim it down. And particularly being in a TFSA, there's no tax implications to selling. If it was there's going to be tax consequences, maybe you don't want to sell as aggressively. But in a TFSA, I think you probably want to have Power Corp at the price it's at, maybe like at a 10 to 20% weighting. If it's larger than that, you trim it back down to that level. But certainly, I mean,
you'd hold it, you trim, you wouldn't sell the entire thing.
Yeah, I don't think you need to sell the whole thing. It's one that we are trimming it. And I mean, I think if you're looking for, 25%, 30% in the next year, Power Corp's not the name I'm looking at. But if you're looking for just something to continue to collect dividends, have a stable anchor for long-term growth, I think Power Corp has a place in a portfolio.
Okay, let's go to the phone lines. And Catherine's on the line in Montreal with a question. Hi, Catherine.
Hi there. Thanks for taking my call. I'm calling about Maple Leaf Foods. I purchased it about 4 months ago, and it's just been on a steady decline ever since. Everything I read about it, when I try to do research, positive. Most seem to still say give it a buy rating. I'm down now almost about 25%. And I don't know, should I continue to wait and see, or should I sell this stock?
Thank you very much for the question. Taking a look at the line chart there, Jamie, you see that steep drop-off in the fall of last year. Is this a stock you would continue to hold on to? Would you sell it? Where would you go?
Yeah, so a couple of things with Maple Leaf Foods. So I mean, this is just really a case of unfortunate entry timing. Seeing the stock decline as well. Maple Leafs, they also spun out a division called Canada Packers. Mm-hmm. So I'm not sure if we don't own Maple Leaf Foods. I'm not completely up to speed on the whole process of how that went, but I believe shareholders got some shares of Canada Packers as well. So,
which is their pork business, right?
Yeah.
Yeah.
And that's the pork business. They supply Maple Leaf Food, which does the consumer packaged goods, deli meats and stuff like that. But, I think with Maple Leaf Food, like I said, it's not one we own, but it is looking more attractive at current prices because they spun that business out. A lot of the commodity exposure that you get with agriculture, you have price risk on what you sell it for and input cost risk has been eliminated. And they've also gone through a heavy investment cycle. And so now, over the next 3 to 4 years, you should see higher cash flow, higher returns, potentially higher dividends, more share buybacks. So I think this is one that if you bought it with a long-term thesis in mind, I would continue to hold it, maybe even add to it at this level. But having said that, it's not one that we at Murray Wealth Group own in our portfolios.
Okay, that was for Catherine. Let's move on to another caller. Rob is in Calgary with a question. Hi, Rob.
Hi, good morning. Thanks for taking my call. I'm a longtime holder of Quarterhill, and I'd like Jamie's opinion on the stock. In my opinion, the stock is chronically underperformed, and I feel it's become a value trap. So, Jamie, do you see a catalyst for change, or should I cut my losses and move on? Thanks for your valued advice, and have a good afternoon.
Thanks very much. Yeah, that's a long trend line down from last year. They do sensors, sort of connectors?
Yeah, so Quarterhill, it used to be Wyland. They own a bunch of technology patents, but they've been focusing more on growing like their transportation sensors and technology. So for highways, toll roads, the type of sensors that would go into those. I mean, I think this is just a case of a company where they tried to do a strategic pivot. It seemed good on paper, but it hasn't worked out. We actually own Quarterhill debentures, so they're convertible debentures. So we bought these bonds hoping that the stock price would rise and we'd be able to convert those into equity and we'd have a really successful investment. We like them because in the case where what's happened with Quarterhill as a convertible debenture holder, we get our 6% interest coupon, and it turns out that the stock conversion isn't going to happen, and we're hoping now to get our money back in about a year. So yeah, I think Quarterhill, they tried to do this pivot. It hasn't worked, and I think I would be looking at other options.
Okay. Let's move on then to another caller. We have Steve on the line. He is in Burlington, Ontario with a question. Hi, Steve.
Yes, hi. Thank you for taking my call. My question for Jamie is on Definity Financial Corp. thinking about adding it to my portfolio for the long term, say 5 to 10 years, particularly for the reason I like companies who have with a smaller dividend, however, they continue to grow it over the years. So I was just wondering if Jamie thinks that this is a good option for me.
Okay, thank you for the question. So this is an insurance company, a smaller one, obviously. Can you tell me a little bit more about it?
Yeah, so Definity, it's a property and casualty insurance company. So, the Manulifes and Sun Lifes do more life insurance and health insurance. Definity's property, car insurance, home insurance, stuff like that. It's been a great performer over the last 3 years. Their strategy is to continue to acquire smaller insurance companies, bring that in. It's a play of, do you want to own this or do you want to own like Intact, which is sort of the gold standard in the sector. So Definity's been a great catch-up trade of a company that was smaller, executed really well in some acquisitions. And, I think it does have a good 5-year outlook if that's what you're buying it for. I think this is one that you can definitely buy and hold and put away for that amount of time. Again, the multiple, it is a little bit expensive. It's around 19.4 times on a PE ratio basis looking out 1 year. At various points in time over the last 2 or 3 years, it's been more in the mid-teens, called 14, 15, 16 times. So I think that's probably a better long-term entry point if you can pick it up at that 15, 16 multiple. But I think, again, this is probably one that I'd start with a starter position, watch it, and if it trades down, call it 15 or 20%, look to maybe double the position when that happens.
Okay, good one to watch. Let's get to our next caller. Stephen's on the line in Montreal. Hi, Stephen.
Hello.
Hi, go ahead.
Okay, my question is on WhiteCap. I understand that oil these days has a lot of moving parts, and Jamie was talking about entry timing just a couple of minutes ago. So about WhiteCap, with the prices today, would you be a buyer at around $10.84, $11, or would you wait for the stock to go down more?
Okay.
I'll hang up and wait for your listen to your answer. Thank you.
Thank you for the question. So, what a time to be looking at these stocks. Good to think, okay, I'm going to wait for a pullback. There is one now. Mm-hmm. But do you have those longer term concerns that others do about Canadian crude and market price?
So WhiteCap we own some WhiteCap in our dividend income fund. It pays a great yield. I think it's around 7%. We think that yield is sustainable at current prices. If prices continue to move lower, like we're at $55 WTI, I believe, if we move down to the 45 or 40 for any prolonged period, that dividend might be cut. But we think ultimately, WhiteCap should be able to sustain it under a normalized environment. What we like about WhiteCap, they have a great management team. We think it's a very well-run operation company. They merged with Varen last year, which is a new source of upside, and it's just very well diversified within Western Canada. So they do have some heavy crude, which is the crude that if you're worried about new Venezuela imports, the oil sands, that's a bigger concern. So a lot of their production is a light oil. They have natural gas. They have some condensate as well, which should benefit from all this. So it's a fairly diversified commodity mix across that. And I mean, would I buy it at 10.80, 10.90 where it is today? Yeah, I wouldn't have any problem buying it. I mean, we've tended to buy it below $10 and then start to trim it around 11 to 12. But over the years, particularly following the Varen acquisition, we see more upside in the stock now with a larger inventory base. So yeah, it's one that I'd be buying today. And again, looking to add to it if it falls below $10.
Okay. Let's take a quick break. We'll be back with Jamie Murray of Murray Wealth Group. Again, he's taking your questions on North American equities. Back in a moment. Welcome back to Market Call. Let's go right to the phone lines. Alan on the line in Victoria, BC, with a question today for Jamie Murray. Hi, Alan.
Oh, hello. Good morning. Thanks, guys. My question is on Exchange Income Corporation. It's breaking through its new highs, and I've held the stock for like 15 years. Should I hold it for a little bit longer? Thanks very much.
Okay. Exchange has, a bunch of different companies that it buys into. They've done pretty well, I guess, over The last, what are we looking at, from the April down, it moved up greatly. Now 56% up over the last 3 years at 86.55. Is this a company you would put into at this point? Would you trim back on the growth it's had?
Yeah, so, Alan, congrats on holding this great company for 15 years. Your return must be phenomenal. We bought this stock back in 2017, so not quite as long, but we continue to hold it. It's one of our larger holdings in our income fund. It's around a 6% weight. So we really like it. I think it was a top pick of mine 3 months ago, around 77. So at 86, happy to see that move up, but definitely not one that we're looking to sell aggressively or get out of. Our target price is over $100. And yeah, like you said, just on operationally, they're firing on all cylinders. They own a bunch of great aviation assets in northern Canada. So they do medevac. So that's where they're moving health patients out of remote communities.
They do surveillance as well, yes?
They do remote surveillance for governments all around the world. And there's a big contract in Australia that we're waiting, sitting on pins and needles to find out about. It's a $500 million contract that they're one of 2 final bidders on. So lots of opportunity for this. And now as Canada looks to move into the Arctic and look at Arctic sovereignty and nation building projects in sort of remote areas of Canada, Exchange, we think, has multiple ways to benefit from all that, increased defense spending, lots of different levers. So this is one that we're holding, and we really like this company.
Okay, let's go to our next caller then. Chris is on the line. He's in Delta, BC. Hi, Chris.
Hi, Morella and Jamie.
Go ahead.
I would love to hear your opinion on Lululemon, please. It's been talked about a little bit more lately. It's about a 3% weight in my portfolio, sort of on the riskier side, and I will look forward to your thoughts. Thank you so much.
Okay, thank you for the question. So Lululemon, change of management coming, right? There's an interim, I guess, CEO right now. And the competition in that space has really increased over the last number of years, not to mention the knockoffs from Costco, and I know there's some legal action in that space as well. This is a company that has really dramatically dropped down after doing very, very well. Do you see a comeback for Lulu?
Yeah, we do. So we started to reacquire Lululemon stock this past summer around 200, just below the $200 level. So it's up a little bit from our initial purchases. We bought some more when it fell down to the 160, 170 range. And you're right, it's a turnaround. So there's lots of things that need to go right. But if they do go right, we think there's 50, 60, 70% upside in this company. We don't think Lululemon's a broken brand. We think they're still going to have lots of growth internationally in China and Europe, other Asian markets. But it's really about getting the North American business, and particularly the U.S. business, back to growth. It's been flat for the last 2 years, so they need to figure that out. That's where that new CEO is going to have to come in, and we still don't know who that's going to be, so that's going to be a key thing to watch. They also have a new designer whose designs will be hitting the shelf this spring. So in the next 3 months, we'll get to see how those new products are selling through. And it's all about Lulu finding its roots, coming up with interesting technical apparel that shoppers love. And if they can do that, yeah, we think there's 50, 60% upside.
Is there any specific stumble you saw that led to them moving down the way they have? Or is it just more, as I mentioned, competition in that space?
Yeah, I think there's 2 factors. So they used to have really tiny stores, and they still kind of do. They're smaller, like 3,000, 4,000 square feet. Whereas Aritzia, another stock we really like, has been building 20, 30, 40,000 square foot mega stores. And so as Lululemon moved out of just doing, yoga pants and yoga tops to tennis, running, other clothing, they expanded their assortment. Their stores got too small. And so they need to expand the size of their stores and build some more experiential stores. But then they also just missed a little bit on the fashion. They got a little bit lazy, we think. That's where the new designers have to come in and sort of revitalize that. But we still think the brand and the quality and the loyalty that they have with a large portion of the consumer base is going to stand out, and that's what will drive the stock higher.
All right. Good to know. Let's move on to the next caller. Then Jesse is on the line. He is in Calgary. Hi, Jesse.
Hi, good morning. Thanks for taking my call. Just wondering your thoughts on Celestica and the outlook for the next year or so. Been holding this for a couple of years. It's done pretty well in the portfolio, so just wondering, would you be trimming, buying? I'll hang up and hear your reply. Thank you.
Thank you for the question. Celestica at 418, down a little bit on the day, but a pretty good run, again, from that April down point of last year. What do you think about Celestica?
Yeah, so Celestica, we currently don't own it. We haven't owned it in the last 5 years at least. We own Broadcom in our global fund, and Celestica is the company that is, I don't say they're riding Broadcom's coattails, but Broadcom's creating these TPUs for Google, which are competing with the NVIDIA chips, and Celestica benefits because Celestica kind of takes all the different components, puts it in basically a box, and then sells that to or delivers that to the end consumer. So they've really been benefiting from this growth in the TPUs that Alphabet and Broadcom have been delivering. If that continues, and we think it does, we still really like Broadcom and Alphabet. Celestica will continue to do well, and if Broadcom can expand the number of companies that it works with building these custom AI chips, then Celestica is probably going to benefit from that. Having said that, this is a stock that traded at 10 times 2 years ago and now trades at, I think, a 30, 35 times PE. There is going to be lots of growth over the next 3 years, but we do struggle a little bit. Like, is what they do just a commodity service? There's lots of other companies out there that do this type of work. And, will Celestica eventually, if and when this does slow down, see a lot of margin pressure in addition to potentially volume pressure if they lose any of that business? So I would say it's been a great performer, and I would probably be definitely taking my money out and playing with the house's money at this point. But it's gonna continue to be quite volatile from here.
Okay, let's take another quick break. When we come back, we will go through Jamie's past picks. That's next. Time now to have a look at past picks from Jamie Murray. These are from February 25th of last year. At the time, Starbucks was his top pick, SBUX on the NASDAQ at 114.59 US, now to 88.59. So 23% drop and a total return 21% drop. Starbucks has been trying to turn its future around a little bit. They laid off, they've closed some stores. They're trying to come back as the coffee house you could hang out in, essentially. It doesn't seem to be going well yet. What's your interpretation of where they are in that process?
Yeah, so the big hit that Starbucks took this past summer was when they announced that they were going to actually be, and they are closing stores and laying some people off, laying management layers off, but they are actually hiring more baristas per location to try and improve the operations and efficiency and speed and service. And so we think that is the right thing to do longer term. Ultimately, it is a premium brand. You want to have that great service. You want to be able to get your coffee when it's 8 a.m. and everyone's trying to get their drink and have to wait 15 minutes. That's when you get people just skipping by the store rather than stopping in. So great thing to do, but it kind of reset the earnings estimates lower for the next couple of years from which they will now grow from. Okay. But we still see under the hood a lot of positive things the new CEO, Brian Niccol, is bringing into place. We think this is going to be, the plan's called Back to Starbucks. We think they are going to bring back the old Starbucks that was beloved and be able to grow and find lots of opportunities. And we're starting to see some green shoots in that. It's been a tough restaurant market as well with the consumer sentiment low. So it's been a tough year. Not my best pick, but we still like it for the long term.
Are you holding on to it?
Yeah, we still hold it. We've been adding to it in the 80s.
Got it. Okay, let's go to your next past pick, Amazon. Very well known, of course, on the NASDAQ, 212.80 at the time, US. Now to 243.46, so 14% upside. Total return the same. Amazon, I imagine that you're still holding on to it. Are you picking up any more? What do you think about Amazon's future and where that lies?
Amazon is now our largest or second largest holding in our global equity fund. It was a large holding last year too, but we made concerted effort to bring it up to the largest holding last summer. We just see multiple levers for Amazon to win. If you think about their retail e-commerce delivery side, they grow faster than Walmart and Costco. They have higher margins than Walmart and Costco. We think they're going to run away with this over the long term. Yet the stock trades at a big discount to both of those companies. And then if you look at the Amazon Web Services side, so more the AI play, I'm not going to say they're the leading AI company, but we really think in terms of AI data centers and infrastructure, it's going to come down to Amazon, Alphabet, and Microsoft as really the leaders in that. And we think they're going to grow this division over 20% for the next 2 or 3 years. And this year, Amazon actually has a ton of power capacity available, which a lot of other companies are still looking for power. And so we think there's upside optionality on the AWS side in 2026. So we still really like Amazon. We think this is a company that has, like I said, multiple ways to grow. They're a leader in robotics, a leader in advertising. And so this is a company that we're going to continue to hold for a long time.
Okay, let's get to your next past pick from last February. Kering, PPRUY, was $28.58 US at the time, now to $35.14, so 23% upside, 25% total return. And they're sort of a luxury brand house. They have a number of brands underneath them, including sort of Gucci and McQueen. So is this something you still hold? And what made you look to the luxury brand as an investment?
So we really love the luxury space. We own LVMH in our global growth fund. And in our dividend income fund, we need a 3.5% yield to put a stock into that fund. And so when Kering it had a pretty strong precipitous fall from 2021 through 2025. I don't know if there's a 5-year chart. But the stock came down, the yield hit our threshold, and we're saying, we can now add some luxury exposure to our income fund portfolio. And so we bought Kering. It was a bit of a mess. Gucci's sales were way down. They have a lot of exposure in China, which is way down. And the luxury market as well just was going through a cyclical low. So it was a good time to add it. It's still in that turnaround mode. They brought in a new CEO last year. And, we think the turnaround is starting to take hold. Now, we did eventually sell it around the current price, I think, in October. That's because that yield did start to fall below that threshold. They have a variable dividend. So when the new dividend rates came out, it just didn't meet that income criteria. But okay. I think the luxury market is still a good one, LVMH and Kering included.
All right. Let's take a quick break. We'll be back to take more of your questions in just a moment. Welcome back. Let's go to Robert. He's on the line in Burlington, Ontario. He's got a question today for Jamie. Hi, Robert.
Hi. Jamie, I'm holding Well Health. It's nice to see that stock up above $4 now. But what I'm interested in is the spinoff. That spinoff is financed. It's ready to go. So the announcement should be coming out any day now. But Well Health is still going to hold 80% of the spinoff. Do you have any sense of what the spinoff valuation might be, and how will that impact the Well Health shares themselves? Thank you.
Okay, thank you for the question. Can you just expand a little bit on what Well Health does? I think they sort of have a hand in operating a number of clinics, right?
Yeah, so Well Health, they own and operate a number of clinics. They have a software suite that they bring in, that they standardize across the industry in Canada. Then they also have some U.S. assets as well, which are not necessarily related, and they're looking to sell off those assets. And so Well Health, this isn't a company that we own, but it's one that we're starting to take a look at. It is interesting down here at the $4 level. And they have numerous transactions, the spinoff. They own I think it's a company called Heal Well AI. They own part of that as well. And then these U.S. assets. So the market's really just a little bit stuck until they see some of these transactions actually go through. So the U.S. assets, we can try and guess what they're going to be worth when they sell them, but until they actually execute on it, the market doesn't know. So I think there's a lot of investors like ourselves who are in this wait and see mode and wondering what's the holdup for some of these transactions to happen. If these are really great assets, then why aren't you executing on these sales and transactions that you've said you want to? So, at $4, when all this comes through, I think there's a lot of value here, but they certainly have to get it to a little bit cleaner structure to get excited about it.
Okay. Let's move on to Mike then. Mike's in Toronto with a question. Hi, Mike.
Hi, I'd like to ask about Northwest Healthcare. I've got a little bit of REIT money coming in from some takeovers. Do you think this is a good one to put some money in, or do you have any other preferences? I know you liked it in the past.
Okay, thank you for the question. We'll bring up Northwest Healthcare here. Do you like the space, first of all?
Yeah, I like the REIT space. They're all trading at mostly discounts to their net asset values, which now properly reflect, current markets and current interest rates. Their balance sheets are, reflective of current interest rates. So what happened in 2022, a lot of companies had to refinance their debt, and you're going from 1%, 2% interest rates to 5%. And that was just a big headwind on your interest expense. And that's what happened with Northwest here. You can see on the 5-year chart. They had too much short-term debt. It got repriced. They had to do a fire sale on some assets. Now the company's stabilized. This was another one that was a top pick 3 months ago, and so we really like it. The net asset value on this company is, I think, around $7.50, $8 a share. And there's a new CEO who started last July who's taking action to realize the underlying value of the company and the structure. And so we think this is a great entry point right here. It's a large one in my personal holdings like TFSA, and it's a large holding in our income fund as well. So yeah, I'd definitely be looking at Northwest Healthcare as the next REIT that is going to perform well.
When did you pick it up? Last year? Late last year?
We've owned it over the last 3 or 4 years, and we did own a smaller position before it had its precipitous drop, but it's really been the last 18 months where it's gotten really interesting. We're trading at this huge discount. The management team's taking steps to realize value, and it's a pretty good business. They own hospital assets and healthcare assets. There's not a lot of economic sensitivity in this. It's trading at a 7% yield. They're buying back stock and bonds and paying down debt. So there's a lot of good things underneath the hood, and we like the space.
Okay. Let's go to Mark in Ottawa. He's got a question today. Hi, Mark. Mark, are you there? Okay.
Yeah, sorry.
Go ahead.
Sorry. Yeah, your thoughts on UnitedHealth. I know you've liked it in the past. What do you think for 2026? Thanks.
Thank you for the question. We had a number of guests who have recommended UnitedHealth because it dropped down very much. It's coming back a little bit, sort of in the fall. But what is your forward look on UnitedHealth, which has faced a number of challenges last year?
Yeah, so UnitedHealth is a company that we've owned in our global equity growth fund for over 5 years. So we've liked it for the long term. They obviously had a very tough first half of the year last year and a little bit of a recovery. But what is really interesting about UnitedHealth now is I think a lot of these headwinds they're facing, and they did face, are starting to fade. A lot of them were medium-term issues where they had to reprice contracts that was going to take 2 or 3 years. There's also extremely high medical cost inflation in the United States. So the cost that UnitedHealth would have to pay for reimbursement was just going up and up and up. When they talk about their 2027 guidance, we think they're being extremely conservative on a lot of these assumptions, using very, I'd say, aggressive assumptions on what could go wrong and not really giving any credit to what could go right. So we think this is a company that we're going to see the earnings revisions, EPS move higher over the next couple of years. They're going to be an AI beneficiary as the largest healthcare company in a very complex space. They're going to be able to use AI to improve efficiency. We just think expectations are still very, very low, and we'd be buying it today.
Okay, let's take a quick break. We will be back with more of your questions in just a moment. Welcome back. Alan has been holding on the line in Ottawa. He's got a question today. Hi, Alan.
Hi. Thank you for taking my call. My question is on Novo Nordisk. It made an announcement about a week ago that it's providing a pill for weight loss instead of injection. And this is really big news. But the stock hasn't really moved up a whole lot since the announcement. It has moved up, but kind of muted with such a big announcement. And I'm wondering, would you be getting in at this price, or is the news baked into the stock price right now?
Yeah, I was going to say he might have just hit on it right there. There was so much talk early on about that transition from a shot to a pill. Maybe the news fell flat?
Yeah, so Novo and Eli Lilly are the two companies right now fighting over the space. There's new entrants who are coming out with new formulations that will be hitting the market, in 5-10 years from now. But right now, it's really a battle between Novo and Lilly. And Lilly saw the market better than Novo did and secured way more capacity than Novo Nordisk did. And they've executed better. We think their revenue and sales are going to grow much faster than Novo. And so we've owned Eli Lilly, and we haven't owned Novo to date. I mean, it's had a huge drop in the last 18 months, and it is looking more interesting, but we just still think Lilly still has a better growth outlook. And just in terms of the pill, the announcement was expected. It was a little bit earlier than expected, but I mean, as you alluded to, the pills have been the next step for both of these companies. But we think the Eli Lilly pill is going to, perform much better in terms of at least sales and scripts than the Novo pill. And so we still own Eli Lilly for their new pill when that hits the market later this year.
Okay. Let's go to Jim then in Pickering. He's got a question. Hi, Jim.
Hi, good afternoon. Thank you for taking my call. The question today is on Canadian Natural Resources, and I've got that elbows up feeling lately, and so I'm just adding to my quality Canadian companies. Yesterday I did Enbridge, and so I would like to get your opinion on Canadian Natural Resources in view and in light of recent events.
Okay,
Thank you.
Thank you for the question, Jim. And I don't know how you even approach the situation right now, because it's changing constantly with the Venezuelan factor. And CNQ, like a lot of the oil stocks, have been pretty low and dragging. And this sort of doesn't help the new information that's coming in. What do you do with a company like CNQ at this point?
Yeah, so we own CNQ in our income fund. I own some personally in my RSP. I think it is one of those great sleep at night companies. I have no concerns over the long term with Canadian Natural Resources, because if we do get into a tougher market, we think they'll do some acquisitions, they'll do some accretive events that they've historically done in poor oil markets, and we think over the long term we'll be rewarded owning this company. Having said that, the Venezuelan news is a short-term negative. We're seeing incremental heavy oil flow into the U.S. Gulf. What do you do in this situation? I mean, I think we're a little bit more just concerned about the general oil price. Like, that's why we're not rushing to scoop up shares, even though it's down 5-10%, because we're seeing just like weaker oil prices. But certainly it's getting close to that level. I think it was below 40 6-9 months ago, and I think that's probably where we start to dip our toes in again. But certainly I have no problem. If somebody said I bought some CNQ today at current prices, we'd have no problem if it's a long-term hold.
Okay. Let's move on and get in one more caller. Dennis on the line in Victoria, BC. Hi, Dennis.
Hi there. Thanks for taking my call. Interested in your opinion of WSP Global, Jamie. Thank you.
Okay. Go ahead.
Yeah, so WSP, it's a company that it's on our radar. We don't currently own any, but we do like the engineering space. So they're really rolling up engineering companies around the world. They just did a large acquisition, I think last week or in the last couple of weeks, which further adds to that growth. That's really where the growth is mostly going to come from, by buying these companies, using debt to finance it, along with a little bit of equity, paying down the debt, getting some synergies from that. And so they've executed on that strategy really well over the last 10, 15 years. The multiple on the stock is down with some of these acquisitions, and the share price not really moving up too much. So definitely a nice time to pick away at it. I don't think it's quite at the entry price that we're looking for. We're looking for a PE ratio, I think, below 20. It's still around 22, 23 times. But if it were to fall 15, 20% from here, we'd definitely be, I think, looking to scoop some up.
All right, let's take a quick break, then we'll be back with new picks from Jamie. Stay tuned for that. Join us tomorrow on Market Call. Stan Wong on the show, portfolio manager at Scotia Wealth Management. He'll take your questions on North American large caps and ETFs. And if you missed Market Call, check out our daily podcast. You can find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. And time now for new top picks from Jamie Murray. We start with a familiar name, NVIDIA, on the NASDAQ. NVIDIA off its high for some time now, but climbing back to the 190 range. Do you see sort of a lot of growth for this company or just capitalizing on what they are already shipping out?
Yeah, so we think the estimates for 2027, which is their year ends end of January, so 2027 is really the next 12 months, 2026. We think they're too low. Jensen, the CEO, has been talking about potentially $400 billion of revenue. The market thinks they're going to do around $330 billion. So we think there's upside over that time frame, just in the short term. And we think that, whether it's 400, 380 billion, 360 billion, we think the next 12 months is pretty much locked in because they have these new NVLink 72 chips are just hitting the market. We're going to see, we think, an acceleration in both training.
That's the Rubin?
That's the Rubin, and they're right now on the Blackwell architecture. So they're on this annual cadence that every time they put out a new chip, there's just more and more demand for that chip. And beyond the chips in the data centers, we think we're going to be moving into more of a robotic area. At their CES show a couple of nights ago, they were talking about their autonomous vehicle models. We think they're going to be a leader in robotics. So we think there's a lot of optionality that isn't really priced into the stock at all. And trading at 20 times earnings in a couple of years, we think that's too cheap for the upside we see in the next 2 to 3 years.
All right, NVIDIA as your topic there. Let's get to your next pick, which is 3i Group. This is a group out of London, and they sort of own discount stores, essentially. Can you tell me a bit more about the group?
Yeah, so it's an investment company. They run it like a private equity style, so they'll buy a company, lever it up, sell it 5-6 years later for hopefully 2-3 times their money. But unlike a traditional private equity firm, all the capital is just internal shareholder capital. So they don't have funds, they don't have outside investors. It's all just the money inside 3i Group. When you say discount stores, their largest investment, which is 75% of the firm value, is a store called Action. It's a discount retailer right across Europe, continental Europe, so France, Germany. They're moving into the southern European nations like Spain, Portugal, Italy. And it's really just one of the best growth stories we've seen in retail. It's right up there with the Walmarts and Home Depots and Costco's of the world in terms of how fast their sales have grown and how their locations are growing. We think there's opportunities outside of continental Europe, so in some Asian markets. They're even looking at potentially expanding to the US. So we're going to hear more about that, I think, in 2026 or 2027. But really, it's a company that we think is going to grow. Action is going to grow 15 to 20% on an EBITDA basis over the next decade, potentially. And that's not reflected in the share price today. So
and clearly there's an appetite in Europe for this kind of a retail store. I was wondering if that existed because you see those big chains in the US and you think Europe doesn't really have the same appetite for that.
Yeah, exactly. And so Europe is a much more regionalized, like each country in Europe has their own banners, and Action's really been one of the few successful. And really the general merchandise has been like the Aldi's in more of a grocery format that have expanded around the world. But Action's really dominating in terms of general merchandise. And with their scale, they find they tend to put a lot of the local players out of business over the long term, and that just further perpetuates the growth that they have.
Okay, let's get to your third pick then, which is Dolman Building Materials, which is an interesting choice because they deal with lumber, and lumber's been under scrutiny, of course, with the tariffs from the U.S. What do you like about this company?
Yeah, so Dolman, I always like to have an income-focused pick, usually in Canada, and Dolman's that pick today. Dolman, like you said, they deal with lumber, but it's really, if you think about an oil pipeline or a midstream company like a Pembina on the oil side, Dolman's similar to that, where they're just buying the lumber from the forestry company, whether it's just distributing it, so moving it to the end retailer and holding that inventory, or treating it, cutting it down into different wood sizes, like into 2x4s or into furniture parts or fence posts. So they don't take a lot of that volatile price risk that the real forestry that's super volatile takes on. it's more of a margin and volume business. And they've really done well consolidating a large position in the United States. They've always been a leader in Canada, but now they're, I think, 20% market share in the United States. And as they get more and more volume, they get more and more efficient. They're able to take more and more share of the market through that. And it's going to be a growth through acquisition story. So they're going to look to buy new lumber mills and treating plants. And as they do that, they use some debt, they lever it up, they pay that debt off, and then it just feeds the cash flow. And with a 5% dividend yield, I think the actual free cash flow yield is probably closer to 10 to 15%. So lots of room for that dividend to increase once they pay down their debt a little bit.
And I was going to ask you, you're saying they're buying some, will they buy mills, for example? Because you're going to see some of the lumber players be pushed out. Would that be an opportunity for this company?
So it could be. They definitely own some sawmills. They're in the specialty side. So they're not just really taking the raw logs and sawing them into smaller pieces, but they're taking that inventory from the end forestry company. Again, whether it's just distributing it or cutting it down even more, or treating it, like pressure treating it for decks and fence posts, doing that and then selling it to the end retailer. So it's a great business model in that market.
All right. Got to leave it there, Jamie. Thanks for coming in. We'll see you soon.
Okay, thank you.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.